Cool. So welcome to today's Sifted Talks in partnership with Remote. So lots of startups right now, especially post-pandemic, are kind of making the most of the talent and perks that having a global team can bring. But one complication that having employees situated all around the world is kind of working out the complexities of cross-border equity compensation. So offering favorable stock options can be a good way to bring the best people to your company, but as the company grows and develops, founders need to make sure that these terms remain fair and attractive. So to help us unpick some of the questions that tend to crop up on this topic, today I'm joined by Job van der Voort, who is CEO at Remote. We have Valentine Harsha, General Manager at Easop, which was acquired by Remote. We have Davinia Hoddenot, Head of People at CloudNC, and Henry Lompu, who is Head of HR at Printify. Thank you all for joining me today. Before we get into discussion, I'll just highlight to the audience that we do have a Q&A box on the call today. So if you have any questions that you'd like to pose to our panel, pop them in there. Try to make them generally helpful rather than super specific to your startup, if possible. And if you see a question that you like the look of, you can give it an upvote to kind of rank it a bit higher. And we'll try and hopefully address some of those today on the call. So I thought today we could start with a question that's kind of quite broad, but important. Why are employee stock options an important thing to get right? So why are we kind of here talking about this topic today? And what are the potential risks or consequences if they're not done right? So maybe, Job, it makes sense to perhaps start with you for this one.
Yeah, I mean, first off, I think that employee stock options, what we see is that they are mostly given in the US by US startups, and it's much less prevalent outside of the US to give them. And one of the reasons is, of course, because companies don't know what they don't know. They don't know how do I construct this? How do I set it up? How do I make sure I'm compliant and I don't face, for example, a scary tax bill or I do something that's not legal. And the problem is that the rules and regulations are different for each country in the world. And so it is understandably daunting. On the other side, like, why is it important to get right? I think it provides an opportunity for employees, right? It's another way to reward people. And I find it something magical about startups that if you get a piece of ownership in a company, it helps with retention, and it gives the people that you work with an opportunity to have, an outsized outcome. If the startup has some sort of an exit, it gives the employees the opportunity to benefit from that, which is great for the employees, is great for the company, and it's actually one of the main drivers of new startups, right? Startups are often started by people that had great exits as employees in other companies. The exact same goes for me. I got stock options in my previous company that allowed me to start Remote, and I think that's generally a really good thing.
Cool. Valentine, do you agree with those thoughts?
Yeah, of course. And Job and I are pretty much aligned on like the value of equity compensation when you take like total compensation into consideration. But what I wanted to emphasize here is that, how low the education level is around the world and in Europe more specifically. And I'm thinking education level of both the employees, the receivers, but also the employers, right? Sometimes there are like misconceptions about like how complex it is, how costly it is. And even if when it's done, it can be tempting to kind of take shortcuts, take shortcuts and make things, fast and not compliantly. And that might be super detrimental employee for the company as well, and kind of, be really bad for future relationship, right? It will backfire at some point if the company is successful. If not, maybe that will be okay, but that will be sad as a story, right? And really, like, with this goal of aligning the interests and bringing the founder's mentality within your team, I'm fully supportive of companies, and that's what we've built with Easop that got acquired by Remote, to bring like full transparency on equity compensation. It's, raises some questions and some risks about like information being spread out, and we will cover that later in the call today. But it's so important to get it right from the basis and not take shortcuts or expect from team members that they know everything about how stock option work, how a company valuation work. It's not as easy as, you know, just understanding how your the cash that you will get at the end of each month, right? It's something that is much more long-term, that has tax implications, and all of that should be addressed early on, so that both the company and the employees can benefit from that long-term upside that you know, everyone is dreaming of when you join a startup and embark on an amazing journey.
Yeah, nice. And that kind of brings me quite nicely into my next question, which is apologies. What do startups with employees in sort of multiple European countries or countries around the world often get wrong about stock options? And kind of what are the common misconceptions or pitfalls that you might fall into?
Yeah, if I may, because that's basically Easop's goal, right? To kind of find a workaround to those issues that you raised. You know, global regulations are evolving constantly. You know, it's kind of a dynamic landscape, and that's part of like this whole you know, reaction that we see of companies being afraid about setting something up in countries they don't really know or that are changing fast. So it's super important to know that it's getting better. In so many countries since we started Easop, we've noticed that companies and you know, governments, they basically want to ensure they have a thriving startup ecosystem, and that goes with helping founders and early joiners benefit from a very nice upside, and that you are able to issue stock options at a very low price for your employees, and that they benefit for a nice upside. That requires some legal work that can be streamlined, and sub-plans at countries like France and the UK, they have their own instruments right now, like EMI in the UK, BSPC in France. But even if there is not like a local instrument, there are always ways to benefit from an improved taxation if the employer really takes the time to look at the alternatives that are available and just monitors that over time, and just doesn't do a one-off exercise and saying, oh, that's how it works, because maybe 6 months later there is something that is really much better, and maybe you should consider that. And that's the difficult part, but that's the same with any other concept when you employ someone in a country. And that's why you have solutions like remote, where you can basically say they will take care of all those questions, and I'll benefit for that. And that's basically paying for a nice product and service. And you can do the same with equity. So I think that it's kind of a misconception that people think it's, you know, too complex to be done. I think it's actually feasible, and that companies should really consider finding a solution to provide their employees with these solutions.
I agree with what was said before. I mean, it is more common in the US, not that much in Europe. In the past, say 10 to 15 years, it has been like the blind leading the blind a little bit, whether it's on the employer side, founder side, people team side. Perhaps one of the things to consider is that you should not rush with your first sort of stock option plan. It is very easy to feel the pressure that I have to have it because everyone around me is starting to do it, and I need to have something in place and sort of solve for that given moment in time, but not really think how this will scale if my company goes from like 10 people to 100 people, 500 people. So perhaps maybe one of the things I feel companies might get wrong is that they don't get the basics right. Anything from what is their philosophy to granting stock options, where do they make exceptions, who do they give it to, when will they review? But then also in trying to solve these scenarios, introducing too much complexity too soon. Ideally, you find some sort of a balance where you cover the basis, but then you also think, okay, but maybe 2-3 years from now, if I have 500 plus people, 10 more countries, how will I do that? So planning for a few scenarios without too much details.
Great. And so, sort of on that note, one kind of important aspect I think on this topic is making sure that the policies that you have in place are fair. And kind of fairness is a term that's thrown around in this context quite a lot. And I want to delve into that a little bit and ask you today, kind of what is fairness when it comes to offering stock options to employees? Like, how much should you be setting aside? What should your strategy be? And sort of how early should you be thinking about those policies and having those in place?
I would love to talk about this, but Davinia, we haven't heard from you yet. Maybe you can.
Yeah, no. Well, I mean, I'll throw back to you afterwards, but I think when I think of it for fairness, it's making sure that we're consistent across our business and the offering that we make to all of our employees, so that we know we've got that transparency from day one, and can, as we look at it, and we'll go on to this later, but therefore moving onwards throughout their life cycle with us, we look at their performance and then we award additional equity at those stages. But for us, key here at CloudNC is transparency and consistency with what we award from the starting point when someone sort of joins our organization. I'll throw it back over to you now, Joe.
Thanks, Davinia. So yeah, I mean, I think if you found a company, you really should think about this in the early beginning, right? If you're planning to issue equity at some point, you want to, especially initially, do it proportional to the risk that the people take by joining your company, right? An early stage startup is not able to compensate to the same degree as a larger stage when it comes to cash, but they can in equity. And so that's usually how startups gain a balance and also are able to hire great people that, take significant risk. Because if you join a company that's just starting out, the risk that they lose their job is extremely high because the company is likely going to go out of business. And so the way I always think about this is that two things. I think first, you should be as generous as possible as a founder, right? This will only come back to you positively. And second, let it be proportional to the risk people take, especially initially. So, right, I think you want to be very generous towards early employees. And as your company scales, you want to be really clear what it means, right? And I think this is one of the things that we see is that it's really hard to understand the value of stock options to most people in the organization. And so being really clear about what is the value that you're getting, especially as the company grows later on and the stock option, is rewarded to tens, if not hundreds of different people, or if not thousands of people, you want to be really clear on exactly what are the policies, what do we give to whom, and why? Why do we reward certain roles more than others?
I would second that, especially on being clear on the policy. I think Davinia also said that transparency is super important. Getting those policies right, but then also making a clear philosophical choice of how do you interpret fairness in the first place? Are you looking for sort of trying to give the same amount of equity, taking into account salary levels and spending power and where these people are based? Or are you more of a general where you have some type of roles and then sort of a set amount? Both of these can be interpreted as fair or unfair, but making that choice clearly, what is it that you practice, is crucial in being able to justify the decisions, do the education part. If you try to get the best of everything and sort of go down the line of, I'm going to make custom agreements for everyone, yes, you can do that. And if you're in a one-on-one conversation with someone, they can understand it. But if they look at the bigger picture, even if you can rationally justify it, it will still be perceived emotionally, and they will thus say, actually, now that I think about it, it's not really fair across the board. So choosing a philosophy and then sticking to it, I think is a crucial part.
Yeah, if I may add to that fairness aspect, I think it's also important to realize that as the company will grow, the valuation will grow, the fair market value of the stock, so the exercise price, the strike price for stock options will evolve. Yeah, the risk will be lower and lower, but the actual liquidity, will be closer and closer. And so that's to the point, to Job's point, also very important to make people realize that obviously people who joined earlier, they're maybe some of the employees are already millionaires on paper, right? And some will only get, $100,000 of equity value. And they might even be like N-2 versus you, right? It's kind of tricky to communicate that, but it's important to explain that indeed there was this risk and this reward that was taken. And probably that person that is joining when the company is already Series C or Series D, wouldn't have joined a company that was like pre-seed, right? And so that's the kind of philosophy and mentality that you want your team to understand, and that just nothing you will be able to fix, right? You will not be able to go back in time and say, I can give you the equity that was worth at pre-seed stage, because that's you need to look at this risk and how far you are from liquidity. So that's something to be you need as a stock admin or a founder to be very clear on that and very transparent again. Otherwise, that will backfire. That's my thinking.
No, super, super interesting. All good points, I think. Henry, you made me think of something when you were talking about, an employee could come to you and say, well, hypothetically come to you and say, I don't think this is fair. Like the thing that you decided when you started the company, I don't believe this is fair. How would you approach a conversation like that when someone has come to you and said that they are maybe unhappy with the strategy that was put in place? I assume that's a very difficult conversation to try and navigate. So I'm just thinking, if a founder is listening who kind of maybe is in that position, what advice would you have for them?
I would say that it's a difficult position to be in, or organization to be in, if you're not clear on the decision-making criteria. And what I mean by this is that either you have clarity on the types of roles and just a simple amount of stock that they will get, and you review it regularly, or you then take a more customized approach and then say, this is the philosophy that we have chosen. That's why we made this decision. Can you confidently back this up? Or also even understand from what point onwards will you start getting into custom agreements? For example, is it just for C-level? Are you looking at, directors, heads, some crucial talent, etc.? The reality of this is that you can be in these conversations. And like I said, you can rationally justify everything, even if you've communicated, educated, your policies in place. They could technically verify the decision and, using the guidelines, arrive at the same outcome. But the first reaction, regardless, will always be emotional. It's just the way it is. Sometimes you just need several conversations and a bit of time to let the message sink in and for them to accept it.
Got it. Great. And so one thing actually, Valentin, that you mentioned earlier was the question of education. And that's also a really important thing for us to speak about, I think. So it kind of ties into that question about fairness. Like, the average employee doesn't really understand how stock option works. Like, I don't really understand how stock options work, So whose responsibility is it to educate people on that? Like, should founders be making it clear when you have that first conversation? Should employees be educating themselves? And how do you kind of deal with it when some employees are coming into your organization who have got the experience to know how to talk about options, and others are coming in from junior kind of university level who have no idea what's going on?
Yeah, I think it's the employer's duty to and not really a duty, like just the smartest move you could expect, because you cannot really the value of the benefit you're providing to your employee is only as valuable as they think it is, right? So if you just grant equity, never talk about it, never kind of translate it into like a potential future value, people would just think that's cherry on the cake, and they don't get that founder's mentality. So you need to be overly transparent and communicate as the company grows. Like, what does that mean? And get people excited about future valuation and value created already since they joined, and what the future does look like. So it's so important that just not talking about it is kind of a very bad decision as the employer, I believe.
I think I'd add, it's not one person's responsibility. Like, we've taken the approach is that we just need to educate as many people as possible. It's your talent team where they're having those conversations, because they need to be educated and kind of sell what is this perk, and articulate that, the longevity, that journey. It's the hiring back, it's their line manager, it's the people team. So it's that whole journey through. And like Valentin was saying, you keep that conversation going to keep that engagement, and it is a retention tool. So if you don't talk about it, why are people going to stay with your organization? Because they don't understand the value. So for us, it's making sure that when we send the offer details out, that we have some detail that we can share about what does it mean, what does equity data, stock options mean to them. We also have check-in points as well. So each year, the people team will sit down with the individuals. get into, we have a tool that they can log into and make sure that they do understand what the information is showing them and have that frequent conversations, as well as just doing a lot of drop-in sessions. So each quarter drop-in session, so people feel that they can ask questions. I think that's one of the points around exit. No one wants to feel that they're asking a stupid question, but it's not any, if equity was available in every organization, people would know the answers, but it's not common. So we just need to make sure that people feel comfortable in asking anything and just continuing that education piece.
My view on this is a bit different. I mean, I agree with the fact that you need to educate people to a point. They need to understand the vesting terms, the basics of stock options. But I don't think it is always necessarily a training issue. That, we need to make sure that they understand how it works, and then maybe 4 years down the line, 8 years down the line, all of these things will start to happen, and then you have the tax implications, like all of the nitty-gritty details that people usually ask about. But some, I think maybe Valentin said that, like, they need to see the value of it and really believe that there is going to be future value in it. So oftentimes what I think people end up doing is that, you hold your annual Q&As, just try to keep the topic central. You can give them potential valuations, introduce different scenarios that they can play around with. But I think the best way to really communicate that message is that making sure that you have some pool of employees who have already seen the value. And I understand it's impossible if you're just starting out, because no one has been able to capitalize on that. But like, there is no other there's no better marketing tool to say that stock options are worth it. And yes, it's a long-term game, really long-term game. Sometimes it's 3 years, sometimes it's 8 years, sometimes you wait and you don't get anything. But if it pays off, it can pay off really well. And the HR team can communicate that message. Your founder can communicate that message. But if, I don't know, Martin sitting next to me that I work closely together on a daily basis tells me, yes, actually I waited for 5 years and now I was able to, I don't know, pay off my apartment, start my own thing, whatever. That's the most impactful thing. Otherwise, if you don't have enough ambassadors sort of echoing that message, you're going to quickly run into a problem where, yes, you grant stock options, but you still have a stock problem, because you start using it as a band-aid on something that will just sort of start festering quite soon. And they, like, you can speak about stock is great, but if they don't see any value, that tune will very quickly just sort of go in here and then out on the other end. They don't believe in it. So do you have ambassadors? Great. If you don't, try to find some.
Yeah, I love that, Henry. I think I'm 100% with you, and there are ways you can not go bankrupt with that program, right? Because if you have a few millions on your bank account and you have a few people with like a few millions worth of equity, you need to basically buy back those shares and pay them those millions. So that wouldn't be sustainable. But making sure that the ones who can participate to the program only can get liquidity opportunities for a portion of their equity at a fair market value, which is already kind of a gain for some people who joined early, is a quick win and a very smart move, I think, for the employer, as you said, because that will illustrate that it's not maybe going to pay off for your apartment, but maybe it's going to help you get a mortgage or something like that, or will get you like that fancy car that you always dreamed of, or just it's going to, those stories will percolate into the organization, and that will really put a dollar value to these stock options. And that's, as you said, the best marketing you could get.
Amazing. Job, how have you kind of approached that at Remote as well?
Yeah, I mean, similarly, right? Which is, we try to talk about it and try to talk about the value. I as Valentin and Annie were saying, like, I talk about it often, that because I had stock options previously, like I just did, I was able to start Remote and pay off my house, which is also nice. So, yeah, I think that is one of the ways, and I think we're looking at doing much more than that, right? Like, I think one of a really nice thing that we're working on with Easop is just showing you, what would the value be today, right? Like, it's really, it feels very intangible, and it's very easy to say, oh, we raised a lot of money and supposedly, your stock options are a lot, but like, it's nice to actually put an actual dollar amount on it. I think that's a really good thing to do. Yeah, and just continuing to educate people on why this could be meaningful. And to some degrees, it gets easier when your startup gets bigger, because at least I would argue so, because it becomes more real, right? There has been like significant value and the company's doing well, and so you might, the chance of an exit is actually significantly larger. But yeah, it remains really, really important to just talk about it a lot. And I think most of the work has to be done on the moment you do an offer. I think Davini had also spoke about that, which is, just explaining to someone like why this is a good offer. Why is it valuable that you're going to get this thing? Because if you make an offer, if you give stock options to a person and they don't value it, it's a waste. It's a waste of everybody, right? Like it's a finite thing. Your money as your business grows will come in every single month, but your stock options are finite, and it's very painful to grow the pool. So yeah, it's a really valuable thing to hand out. So you should do it carefully, and when you do it, make sure that people actually value it.
Amazing, super interesting. And so that's kind of, we're talking there about employees starting and employees kind of growing within the organization. There's also the matter of when an employee leaves. So how should founders and startups approach stock options and purchasing and all that kind of thing when someone decides to hand their notice in? Maybe Davina and Henry, it makes sense to start with you as the people on our panel.
Yeah, sure. So we make it like, I guess we make it very clear from day one, sort of, this is what will happen upon leaving. So any vested shares we'll make available, contact you about provided with the option to purchase them, and to purchase them at the lowest possible price that we can do that for, right? So it's making sure that even at that stage, we're valuing the contribution that they've made to the organization, and that they continue to sort of be interested in following what we do. But it's making sure that it's achievable for them to purchase them, right? And to value that, as I said, that contribution that they've had. It's not something that's never spoken about. We make it very clear, and it's a very open and transparent conversation again, so that just flows through. I have heard stories, I guess, from people who've been in other sort of startups and have been stung by this quite a lot. So where they've purchased vested shares at a significant price, and those haven't paid off. So therefore, I guess they start to lose that trust and value about potentially pursuing employment with another startup, because again, they start to lose that value in equity. So I think by being able to explain that, what happens from day one, that enables them to sort of get that buy-in. Henry, I'll let you.
I agree. Also, just sorry. As I was saying, I agree. You do need to mention some possible scenarios just from day one or when you make the offer. But also, I feel like there's a fine balance between covering the basics and sort of over-educating people and overburdening them with details that will become relevant exactly at that exit stage, or when there's a liquidity event. So figuring out like how to communicate the right information at the right time in the right amount is a bit of a tricky balance to find. And then also one thing with exits, I think you should be clear on your good and bad leaver policy, and it's easier to think of scenarios that you would not want someone walking away from the business with stock options, and then somehow maybe, I don't know, working against it, or bad PR or whatever. But just to be clear on that as well, because not all exits are amicable. It's normal, it happens. But then the question is, do you then still allow them to be part of that success? Is it justified? Is it not? I would say you should operate on the assumption that all levers are good levers, unless something very specific happens. For example, like a gross misconduct, or I don't know, breach of confidentiality, or something really that you would say, yes, I know that you may have worked really hard for 2 years, but this mistake is something that we cannot tolerate. So trying to find out these scenarios will make your own life easier.
I think there's a lot of work you have to do up front, right? I think you have to be really clear on like what are vesting schedules, but also what are exercise periods that you might have. I think setting those expectations up front, if you know what your exercise price is, if you know what your exercise window is, it makes your life a lot easier. Technically you have to do that. It has to be in the stock option agreement, but nonetheless, being really clear to people about this upfront and over communicating it. Hey, if you're going to leave our company, then you'll have to pay an X amount of money to exercise your options, and that has to happen within a Y amount of time, so that then afterwards, if a person does leave the company, whether it's voluntary or not, you're not in a situation where somebody says, hey, but I don't have this money, or I can't pay this in this window. It will still happen for what it's worth, but at least you did everything you could to prevent that scenario from happening. And there's ways you can construct around that as well. But I think generally just being incredibly clear upfront and say, these are the rules, this is how we're going to do things, then people can disagree with those. They can say, well, an exercise window of a certain amount of time is too short for me and I don't find it fair. That's okay. But then it's up to you to decide to take the offer or not.
Yeah, I totally agree with you, Job. I think it's like the post-termination exercise period is one of those parameters that is kind of overlooked by employees and sometimes employer as well. Although it's, especially in early stage startup, one of the most important. Like you join an early stage startup, it's doing well, but after a few years, they bring in execs that you're not aligned with. You've been working for 3 years in a great startup and it's going very well, but you want to go for your own venture or something like that. You're basically not so close to the liquidity event, but still, if you have like 90 days to exercise and that the company has done well, you might be in a situation where the tax bill associated with the exercise, so the tax on the spread, so the first phase of the gain might be huge, and you'd be like, I just cannot pay those $10,000s of dollars. So you'd be basically not benefiting from these 3 years of vesting. And so by getting a longer post-termination exercise period and making it like 2 to 3, 4 years, 10 years max generally in the US, you'd be able to say like, I'll exercise, the company does an IPO, gets acquired and something like that. And it's much more comfortable when you leave. So the thing is that having a post-termination exercise period is then a retention tool. It's something that people will be like, no, I won't leave the company. Otherwise, I will have to exercise and that will be costly. And so it can be a bit weird in some cases where basically you want people to leave, but they don't because of that tax bill. So what we realized with Easop is that it's super important to allow companies to generate amendments to stock option grants. So it's not that it's set in stone, like that exercise period window, the window that we just discussed, is something that you could extend, shorten, not really, but extend if you feel like it's necessary, right? You have someone leaving and you're in good terms with that person, or you want to kind of make it a smoother transition. You always have the opportunity to say, you should have had 90 days to exercise, or 30 days in some companies, but we'll extend that to 2 years. So don't be too stressed about that exercise and that treasury issue that you might face. We'll extend that and you'll have more time to think about it. You'll see how the company is performing from the outside, but you'll have much more data points to make your decision. So it's so important to know that you can do that as the employer and smoothen the transitions.
Cool. We've actually had, oh, sorry, go ahead, Henry.
I was just about to say that Valentin said that, yes, you make it more comfortable, but it's not only just making it more comfortable, it's just simply being flexible on these exit terms and like figuring out if a longer period is needed. It's not just comfortability, it's good for business. I mean, you could, hypothetically, you could have someone that was very, very happy in their role for 3 years, 4 years. They have significant amount of stock, they had great managers, they had great development, everything was great. And then if you are very rigid with the time period and sort of recognizing that there's a problem there that you could technically solve, but you don't, they feel like you've been scheming them the entire time. And you lose out, first of all, on someone that could potentially exit your company and say, this was a really good opportunity for me to grow. Plus, I got stock options. Now I'm hoping to capitalize on this one day. By the way, they have an opening. Maybe you'd be a fit for that. And rather, you have someone that will then actively feel like, I don't know, I spent 3 to 4 years. Yes, I learned something, but in the end, the breakup was really, really bad. And then that's the part that they end up remembering. So if there's one place that you should look for flexibility, if you have a good lever, it's that place.
Totally align with you. I think you should always make sure that people leaving your company are promoters. Will always bring some good people and good words and good marketing about the company.
Cool. On that note, we've actually had a relevant question, which is exciting. So Valerie asks, why do we need to have an exercise period? So can't we give employees who leave the company the option to exercise at the same time of selling the shares. I don't know who'd like to address Valerie's question.
So you can basically set it at the maximum, which is the expiration period of the stock option itself. It's generally 10 years. Depends. It's basically based on your plan. But after 10 years, vested, exercise or not, your options will expire, let's say. So the max will be 10 years from the moment of the grant and the moment of the expiration. And you can then play with those parameters and say you set a post-termination exercise period of 3 months, 2 years. You can even make it variable and say it's 3 months. But if you stay for 3 years at the company, it gets extended to 12 months. That's something that you can always do. So you can play with that, but that's generally a way also for companies to avoid having a cap table that is just filled with so many people who have left. Because when you sell the company, when you IPO, you basically need to get back to everyone and you need to have their signature or their decision. Are you going to exercise or not? Like, are you going to be a shareholder, or do you want to kind of say, no, I'm not going to pay that. I don't believe in the company and I don't want. But if you need to chase everyone personally, that could really slow down a process that is quite heavy already. So that's why companies tend to make those periods short, so that they clean their cap table and don't have like so many people that are just like, let's wait and see how the company is performing.
Okay. And I think actually on that note, on the point of the cap table, we have another question from Anup, who says, how do external investors in an early stage startup feel about staff equity option plans? Does this dilute their own investment? And I guess maybe Job, as the founder, maybe you're best to start with that.
Investors in startups, they understand that the startup is not built by investors and founders together and nobody else. No, they understand that the first people you have to hire are incredibly crucial to the success of the company, and that people are incentivized if they have significant ownership. And so they generally push pretty hard on actually extending your the amount of options you have available in the pool and issuing sufficient equity. So they feel pretty strongly about it, that yes, you should do this. At least the ones that I've worked with, which is quite a few over the past years. And the individual investors might disagree on details like exercise periods, but I haven't met a single investor that says no, you shouldn't give equity. A single good investor that has said that, I think. No, their dilution, yes, it dilutes them, it dilutes everybody, but that's okay. Because it raises the chance of success of the company, right? So you rather have like a slightly smaller chunk of the pie than having the company not be successful at all.
Started talking, I was on mute, which is a classic mistake. Great. And sort of, yeah, I mean, quite helpful to kind of have that context of the investor point, because I want to talk a little bit about valuations and how the changes in valuation. Obviously, as you grow your startup, you're going to be probably raising money, and the valuation of your company changes, etc., etc. More investors come on. So what should founders consider when it comes to like setting up stock options and having those conversations with employees, and how changes in valuation might affect that, while still making sure that employees feel incentivized and like it all feels transparent? Who'd like to go?
Yeah, I'm happy to talk a little bit about it. I think be transparent about it. That saves a lot of problems, right? Be very transparent. What is the company valued at the last investment round, for example? What is the strike price, which might be different for different options issued at different times, right? And those two things can be separate. And usually they are separate, right? Usually a company has some formal valuation, like a 409A for US companies, that then sets the strike price from that moment for any options issued post that time. And separately from that, the company probably has a private market valuation, which is the valuation you see in the news when they say, well, we raised $10 million at 50 million valuation, and 50 million is the external valuation. But then if you do a formal one, like a 409A, then your company might be valued at 10 million, right? And so this is different from 1 to 5. And I think the most important thing is to just be really, really clear to everybody about this. What are these valuations? What's going to happen to your options? What does it mean in terms of taxes? What does it mean in terms of potential for exit? Because if you join very early, your strike price is usually zero, right? Like near zero. It's like less than $1 per share. And it means that any outcome is positive for you. But if you get your options later on and your strike price is $10 and a company exits for $9 per share, you don't have any exit either, right? Like those options, like your exercise price is higher than the price you're going to get when you sell these options. And so you have to create a lot of clarity on this first, so that if people exercise their options early, which they often do, there's a significant risk that they actually lose them. And the later they join a company, this might be more and more true. Or, for example, and this is really, as an employee, this is impossible to see through, but if the market is really highly valuing companies, like happened around 2021, then it might be that, well, you will never see an exit at a valuation close to what happened at that time. And so I think that's really all you can do, right? Create clarity. And what else can you do? Well, you can do formal valuations regularly. And as a company, at a certain point, you will have to do this. You have to do formal valuations. But it's not like you can like influence them other than just building a good company. If you build a good company, everything goes up and to the right. And that's the main way that this is all going to work out. But sometimes your valuation might drop, or sometimes it might, your formal valuation might stay flat, even though the company is performing well. Just a matter of talking about it. What I do think, and what helped us doing, is that every time we did a 409A, so to formally evaluate the value of our company, we then spoke about what it meant. Because it's really hard to grasp that. Let's say you do one in 2022 and then you do another one in 2023, and the valuation didn't go up significantly, even though your company does much more revenue. The first thought of any employee is going to be, oh no, the valuation didn't go up. That's bad, right? But actually it's great, because your strike price is lower, even though the company is doing higher. And so relatively, probably you're better off. Now, this is really hard to grasp. And this is one of those things where you, as a company, you have to be really transparent and you have to be really clear about it, because new equity is going to be issued at a different strike price. People will see it and people will talk about it, that, hey, my strike price is $10 and your strike price is $11. What is the difference? How does it affect us? Is that good or bad? And I think it's virtually impossible to understand it if you are, just a normal employee who's not worried about stock options. You just receive a bunch and you get all this information. And so being really transparent and explaining what's going to happen when these values change over time, I think is going to help a lot. And then, using tools like Easop to show, well, what would an outcome look like for you? I think that is incredibly important, because then, you can help people understand that you're actually in a great place. Or, well, you just got your equity in a company is still growing. So like right now, if we would have an exit at the valuation of your strike price, nothing would happen. So maybe don't early exercise.
I think it's, as you're just saying, it's the transparency, the communication. I think sometimes there can be a perception that people don't care. They're so busy in their day-to-day, they're not interested. But going back to, I guess, Henry's point as well, you have people in the business who understand it, who really care, those ambassadors, right? And they're the people, the water cooler chats, all of those things, who can piece all the different bits of the puzzle together and can start to spread that. That's what you want to be happening, right? Because then that communication just starts to ripple through. So I completely echo just keep talking about it, right? And that's how you're going to get people on board and understanding. Because keep going back to majority of people, they've never seen it before, right? Like, and it takes a while for it to all to make sense. So transparency is key.
Yeah, and what I wanted to add here is on the fact that, recently a lot of our clients have seen down rounds. So they had a valuation at 20, they have to raise money, it's at 15 millions, right? Well, that you need to basically be clear with that. And there are ways you can kind of correct that and say, you had in terms of value $100,000, and basically today at the new valuation is like $70,000. Either you kind of say, you will see, we'll go back, that's the whole thing about startup, it goes up and down. But if you believe in the long-term value, we'll raise a Series B, Series C at that valuation in the future. Stay with us. Like that happens, right? That's a market correction. You could have that approach. You could also have the approach, which is I'll kind of top you up and I'll bring you back to that $100,000, even though we had a down round, meaning that you will basically have more options. So there are ways you can basically fix that or kind of communicate transparently. It's not something that you should hide, under the carpet and hope that it will go fine, because it won't, basically. So it will backfire, as I said a few times. And back to your point, Job, on the fair market value and that value that is used for the strike price. The way you kind of talk about it can make it like look super bad or actually pretty nice. As you said, if the strike price is low and if the spread doesn't go too high, it means that when you exercise, your taxation will be pretty low, right? So you can be happy with that if you understand that the private value, the market value, is the one that will most likely be used the day there is an IPO or an acquisition, or at least something in that range of values, right? So and there are reasons to explain why there is such a discount. If a company has a private market price at $1, but the fair market value is at 10 cents, meaning that there is a 90% discount, it's because employees, they get common stock, they don't have preferred stock. And preferred stock, it comes generally with like voting rights, with liquidation preferences, and all those things. The employees don't have it, and they will never, because they have common stock. And so that explains the lack of marketability, and that explains the discount. And that's a real reason. If you want to be transparent, you can explain. I'm not sure like all employees need to get that level of details, but you can always get into the nitty-gritty details and explain people, and they don't need to have a degree in finance to understand that logic, because it's really not that complex. It just feels like a black box. It feels like something so complex, but when you have the right tools, the right material to explain how that works, it's generally very interesting, and people should be excited about that as potential future shareholders of the company.
Cool. And then I'm actually going to roll two of our Q&As into one, because I feel like they are quite relevant. And so we kind of touched on this earlier about the sort of how you decide who to give what and that kind of question of fairness. But Brian asks, does the panel feel it's better to give options to every employee to different degrees, or just a select few people? And I'd actually quite like to pose that to you now and say, in the latter case, if you just choose a few people, how do you communicate to the ones that don't get the stock options that they kind of aren't part of that group? So maybe we'll start with that one, actually.
Our approach is very much just here. We'll base it on that. Is everyone in the organization, because you're getting them that buy-in about your company's mission, engagement from day one, right? That's why they're joining your organization, because they want to be part of the company's success. So our approach is everyone. We've always done. But I will throw that, because I guess there might be different views across.
I think it's pretty similar. Usually that's, I think, where companies now, at least in Europe, tend to start. Everyone gets it. It's easier to build that narrative, shared success, shared slice of the pie. We all reap the benefits. And then as you grow and start hiring more for entry-level roles, you might consider that maybe you need some sort of a tenure before you actually are eligible for stock options, or like get past that entry-level role. I think that's also okay if you have a lot of volume going through the entry-level roles. Aside from that, I think you're just doing yourself a disservice if you select a few employees or a few groups of employees that then get stock versus some that don't. You can still have customizability with the percentage that they get, with the amounts that they get. If you feel that some roles are more harder to hire, they have higher responsibility, you can add that and still keep this shared notion of success narrative. But if you really separate, eventually what you're doing is that you are probably building cliques within your organization, and further down the line it will come and haunt you, and getting that ghost out of your organization is quite hard.
I guess and to add to that, we discussed, it's a retention tool, right? So if you're not offering it to people and they see that others are getting that, are having that award, why are they going to stay? Why are they going to want to continue that journey with you?
I have a little bit of a different perspective. At remote, everybody gets stock options, and I think that's usually the right approach. There are companies, a company of a friend of mine, which has a software office-based part, and then they have a lot of retail shops, right? And in retail shops, rewarding people with equity is one, going to give you massive headache, and two, you see extremely high attrition of employees typically. And so there are certainly many cases and many kind of companies where it doesn't make sense to give everybody equity, because you're giving something to somebody who A, won't appreciate it, and two, is probably likely going to leave the company pretty quickly. And so it would, so there are definitely scenarios that I think you should always default to give everybody equity. But yeah, I do think that's a little bit of perspective of a world where everybody that works at this company works in the same office, be it virtual or not, and does a similar level of work. Whereas in many cases that's not true at all, right? And I really think it depends on your company. But yeah, in doubt, give everybody something.
Cool. And then on a sort of related note to that, David asks, what is the typical amount of equity a startup would provide employees? And I feel like maybe this is one that I guess varies depending on the startup, but maybe an add-on question to that is, as a founder, how do you decide how much you're keeping versus how much you're going to potentially give to the employees that you plan to hire along the line?
For when startups get started, usually 5 to 20% of total equity is allocated to the option pool, and it might increase over time. And then the equity that you give to early employees should range like to the first 2 to 4. It should be like, from a max 1% of total equity to, and then descending quite quickly. And then over time, you can plan for it, right? And like that's why we have tools like Easop, so we can actually plan like how many people do we expect to hire, how long do we want to do with this pool, and then relative to that, how much equity do we want to, or are we able to give out? It really varies a lot by startups, but there's actually quite a lot of data available as well. So Index Ventures, they did this big study on this. They have a lot of data to show like, well, this is how much equity startups typically give out and to which kind of people. It's not always up to the founder, right? And if you're starting a new company, it might be that your investors say, well, you should or shouldn't do a particular amount. But I think, I always think you should be generous. I think that doesn't hurt you or harm you in any way. If you're generous, it will pay off.
Especially generous to people that you really build the future with. Like even if you have the system and you have the rules, I think it's also okay if you have custom agreements specifically for the people that you see. They either provide the needed stability and like you need to have them in these roles and they're there for the long term, or it's those innovators that you really see, okay, I'm gonna see what's around the corner and around the next corner, and they will help us scale. These are the people that you should either throw your stock at or throw more compensation at, and then figuring out who these people are, that's a different topic. But if there's if you want to be generous, it's definitely with these people.
Amazing. And then I think one thing I wanted to ask, a quite broad question actually. So what resources would you recommend to a founder, especially first-time founders or founders who are maybe onto their second venture and decided this time I'm gonna talk about stock options. I'm gonna do as the Americans do and offer my employees some equity. What kind of resources are out there to help navigate that topic, aside from, of course, listening to our Sifted Talk? Where can I find help? Kind of where would you direct those founders?
I think that one of the resources that I started with is that Index Venture rewarding talent base. It's amazing. It's really something that they've built over the past years, and it's free and it's available on the internet, and that's great, right? You just start with that, and you have benchmarks, you have like different philosophy that are compared. You understand how taxation works, like at a very high level in different countries. So I would definitely start with rewarding talent from Index Ventures, and then as you want to basically move forward with like an option grant, you obviously have to make sure that your cap table is accurate, it's all in place, that you have your corporate law firm that has kind of finalized the latest round, all the documentation is ready, and then you have multiple options. You know, you work with a law firm, you work with a solution like Easop, and you get this done, right? You move to a stage where it's being granted, it's being approved by the necessary people, and then it's about communication, and the communication can be a spreadsheet. You know, that can be a quick way, you know, to just show the future potential value, and you kind of own the narrative around what this equity will be, and you refer to those free resources in terms of what it would mean in your country if you're hiring internationally. Or you go for a solution like Easop, where like it's all in the app. But that's the approach I would take. You know, just start with like some freely available tools, and then expand to more mature solutions as you feel the need.
Cool. Anyone else have any other resources they'd like to share with founders on the call? It's fine if not.
You can always check out our handbook where we write about how do you talk about equity. So it's remote.com/handbook, and we wrote a bunch about that.
Cool, amazing. Well, thank you so much to my panel for joining me. I think that's probably all we've got time for. And thank you for those questions as well. Apologies if we didn't get round to answering yours, but I mean, if you would like to contact these people on LinkedIn, I'm sure they will be. I'm now offering your LinkedIn's up for communications. Yeah, thank you so much for my panel today, for your time and insight, and of course to our partner Remote for the support, and to our lovely audience for attending.
Thank you very much. Bye-bye.
Thank you. Bye.
Thank you.